Joining me to discuss the key levels he's watching, JPMorgan head of technical strategy, Jason Hunter. Jason, good to have you. Thanks for coming in.
Thanks for having me again, Mike.
An impressive rally since early April by really any measure. The persistence of it, the breadth of it, the magnitude of it. But it's slowed down. I was making this point, like in the last several weeks even, it's just kind of had this sort of like smaller steps, narrower ranges. What does that tell you, and how do you think it breaks from here?
So as a technician, when you see that type of pattern develop, the loss in momentum, and even over the last couple of weeks, the breadth has narrowed. Stocks above their averages, stocks at 52-week highs, that's contracted. You look around the globe, a number of global indices, both in DM and EM, have stalled in range since mid-May. That suggests rally exhaustion. And even we look for very specific patterns. Momentum divergence is one we're very focused on. That tells you there's a bias for the market to correct over the short term. We don't think it's going to be major. We think we could see a bit of backing and filling, maybe down to 5,800, 5,700s, given that setup. But that should be well supported there because the seasonals during the summer are still quite positive.
So that's like, call it a 5% pullback from the recent highs you think is in the cards. Is there a way to try to reverse engineer why the market has been, I guess, as resilient as it has? I was even pointing out, we had that little break on Friday and it didn't even get to its 20-day average, let's say, for the S&P 500.
That's right, yeah. And when you look at the technical setup, really, for the last 2 weeks, it's been, as a chart watcher, you're like, okay, this is pretty negative. I should expect negative price action. You think about the headlines over the last 2 days, and you're like, why aren't we getting it? I think it comes down to positioning. I don't think the speculative community is overly long here. The trend-following CTA community is probably somewhat long, but not over their skis. And I think for the retail community, that's really helped power this rally. I don't think they'll try and sell ahead of a correction. You'll have to twist their arm, so it really will have to come from the specs first. Before that, I think that's part of the reason why it just hasn't sold off yet.
Yeah, retail traders, I guess, it's kind of like they're maybe slow to sell their losers, put it that way, as opposed to having a more rigid sell discipline. The Treasury market, it gets people very excited when yields have gone up to the upper end of their recent range, but I guess if you look over 2 years, they haven't really gone anywhere. So what's that market telling you right now?
So what's most interesting for me looking at the Treasury market, the front end has had the Fed priced for 3-4 eases for a while. It's pretty much range bound. For this year, though, the term premium, the weakness at the long end, the curve steepening, the narrative around that, both the loss of U.S. exceptionalism and the questioning around fiscal discipline. What's interesting is the bonds actually carved out a decent multi-week yield top pattern as it's retested the cycle cheap. Let's call it 415 to 418. And I think if you were to break through, 515 to 518, if you were to break through 480, I think you could see a decent...
On the 30?
On the 30-year bond. I think you could see a decent impulse to lower yields as far as 460, 455, given the way that the chart's set up. And I think that's very much an out of consensus type setup. And when you think about the sentiment and narrative where it is now and the chart forming that, as a technician, that's what gets me excited because it's very much against the grain in terms of what the narrative is out there.
Sure. You mentioned that on the equity side, things have kind of narrowed out, as the rally has matured. What would you think tactically in terms of parts of the market that look better or worse positioned, that maybe they would do worse in this pullback you're expecting, or that you would expect to kind of outperform?
Well, ahead of the headlines this week, it was the deep cyclicals, including materials, energy. When you looked at the commodity markets, they seemed very much well contained below their breakdown levels that occurred in March and April around the tariff headlines, and that very much looked like. So that's still the case with materials. In fact, the base metals look like they are exhausted, and some are already rolling over. Energy, a whole different story because crude squeezed through its resistance in the 60s and got to 80, and we'll see where it gets before this current crisis abates. But I still think probably the more cyclical side of the market, small caps are also well contained below their breakdown zone. They're probably the more vulnerable. It looks like people are crowding back into like the quality, the Mag 7, the big AI tech name. That seems like that'll be the one that holds up well if the market sets.
Yeah, maybe.